Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. You know, I think a lot of investors are missing the proverbial forest because they are fixated on one giant tree: tariffs. You know, it seems like every time the market moves, the pundits and the commentators on CNBC and Fox Business or wherever, they're tying it to tariffs. If stocks are down, it's tariff worries, right? There's been a new tariff, or Trump has threatened a tariff. And if the markets are up, well, a tariff has been suspended, or some trade deal has been reached, or, there's some kind of negotiation going on. Yesterday was a perfect example. There was news that the EU was seeking to negotiate a new trade deal. The Dow was up over 700 points yesterday. Gold shed $50. Now, I'm going to be honest with you. This is just me, take it for what it's worth. But I'm not sure it's wise to sell gold just because the EU and the US might negotiate some kind of trade deal, or because Trump pauses some tariffs, maybe. I mean, I do get it. Tariffs are a big deal, and it's one of the biggest things in the news right now. It's a thing that can have significant impact on the economy, and it's arguably the most significant economic policy focus for the Trump administration right now, although I would argue that maybe we should be paying a little bit more attention to the spending stuff, and we're going to get to that in a second. But what I'm driving at here is that there are other big picture things in the economy, the forest, so to speak, that are being kind of drowned out by all of the tariff noise. And as I just alluded to, one of those is the national debt. It's the spending. It is the budgets. And quite frankly, I think the debt issue is going to have far more impact on the economy in the long run than tariff policy does. I mean, I'll be honest, my guess is a lot of this is going to be resolved with negotiations. And when it's all said and done, the global tariff landscape isn't going to be substantially different than it was when Trump took office. There may even be fewer tariffs if some of these negotiations bear fruit. In other words, they're going to resolve the tariff problem. They ain't going to resolve the debt, ladies and gentlemen. That is not something that's going to happen. And, I've said this before. When I talk about the national debt, and it's a big deal to me. It has been for a long time. I talk about it a lot. But it tends to elicit shrugs. People are kind of whatever, and I get that too. I mean, people have been sounding alarms about the debt all of my adult life, and I'm not exactly young, right? People assume, it hasn't caused a problem yet. They've been talking about this since the 1990s, so it's probably not going to cause a problem. And then meanwhile, you've got this modern monetary theory crowd, the MMT people, who are running around literally claiming that the U.S. can pretty much borrow all of the money it wants to because of, the reasons. And they'll trot out the accounting tautologies to prove it, too. Now, of course, these people are primarily driven by an ideological motive. They want big government. They want government to spend money, so they're trying to justify it. But nevertheless, they're out there, and it does have some traction. And so a lot of people just kind of don't think the debt's really that big of a deal. And, I guess it's not a problem until it is. You've probably heard me use the analogy on the show of, they're playing a game of kick the can down the road. And the question is, how long is the road? I don't know the answer to that question, but I do know that the road is getting shorter and shorter all the time, and there is ultimately an end, and I think it kind of ends at a cliff. Now, I'm sure you've heard other people sounding alarm about the debt. They're out there, the debt hawks. And as I said, I've really heard it most of my life. I mean, you go back to the 1990s and the Republicans, that was their bread and butter. We've got to cut taxes, cut spending. Still hadn't happened. But when people talk about the national debt, I don't think most do a very good job of explaining why it really matters. I mean, like practically what could happen, right? What's the worst thing that can happen? I think most people who are worried about the national debt are really kind of acting on intuition. I mean, we all know that running your credit card to the limit and then getting a new credit card so you can pay the minimum payments on that old credit card, that's not a good plan, right? Not financially sustainable. But it is fair to argue that government debt is different than individual debt. And that's what you'll hear. You start making that credit card analogy and somebody say, well, the government borrowing money is not quite the same. Okay, fine. But it's still not a good idea, right? Yes, the federal government isn't the same as a family. Nevertheless, your intuition is right? Don't let them bully you into thinking, well, maybe I'm wrong. No, you're right. Borrowing endlessly is not a good job, and borrowing money for all eternity is not a sustainable fiscal plan for an individual, a company, or a country. And unfortunately, we're in a situation right now where everybody's buried in debt. I'm focusing today on the national debt because it's been in the news, but consumer debt, consumers are buried under record levels of debt, and the delinquency rates are going up and up and up very quickly. This is something that's kind of percolating under the surface. We're seeing a collapse of consumer borrowing right now. That's not good because we have an economy that literally is lubricated and run on debt. So, people who are like, oh, no, we're not going to have a recession. You might want to look at some of these issues, debt, bankruptcies, delinquencies, because this is all what's bubbling under the surface. And it's what I'm talking about that's getting lost in all of the noise about tariffs. Anyway, I can't tell you when this debt Ponzi scheme will collapse, but I can tell you that it will, and I can explain where it's going to manifest, right? The problem with the national debt is going to manifest in the bond market, and there are already tremors out there in the bond market. And that bond market, if it begins to unravel, it's going to impact the stock market, and it's going to impact the broader economy because it's going to begin to distort borrowing. And then you're going to get the reaction of the government and the central bank, and this is where the real problems begin. So, the national debt got a little bit of play, actually, while I was on vacation a couple of weeks ago. After Moody's downgraded the U.S. credit rating from AAA to AA1. And, my first thought when I saw the headline, I was up in Kentucky and traveling, so I wasn't paying a lot of attention, but that headline did come across my feed, and I thought, well, gee, thanks, Moody. Tell us something we didn't already know. The U.S. it doesn't have a perfect credit rating, and it shouldn't. To justify the credit downgrade, as if justification were necessary, Moody said, quote, successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs. Is it just me, or does that actually seem a little bit understated? It seems actually a little worse than that. And, really, who couldn't see this coming? Right? Moody's even signaled it. In late March, the agency released a very pessimistic report on America's creditworthiness, saying, quote, the U.S.'s fiscal strength is on course for a continued multi-year decline driven by widening federal budget deficits and a rising debt burden and falling debt affordability. So this was really the prelude, right? Basically, Moody's is saying here, we're going to downgrade this credit rating. But, way back in November 2023, Moody's lowered its outlook on the U.S. government credit from stable to negative. And this is often, again, a prelude or a signal that the downgrade is coming. And so here we are, right? And interestingly, Moody's is the last of the major credit ratings to keep the U.S. debt at a AAA rating. Standard & Poor's, they cut their U.S. sovereign debt rating a notch from AAA to AAA plus back in 2011. And Fitch followed suit last year, citing, quote, the expected fiscal deterioration over the next 3 years. So, again, no surprises here, right? We've known for years that the federal government is in a downward fiscal spiral. The national debt surged to over $36 trillion last fall. And, despite some headlines that were generated by Doge, I'm sorry, there is no sign that the spending is going to slow down. There is no commitment from anybody who matters in dealing with this problem. Yeah, there are a few voices out there. You've got your Rand Pauls and your Thomas Masseys and a few others. And you have people that'll play lip service to it. But when the rubber meets the road, they're not doing anything about it. Now, it's interesting. If you go and look at the national debt, the government has a website, Debt to the Penny, and you can go actually look at it. And the national debt hasn't gone up this year because the federal government hit the debt ceiling in January. So that means it can't add to the debt. It can only borrow to replace debt that has already matured. But we all know the debt ceiling is a farce. You do know that, right? Any debt ceiling fight that you hear about is nothing more than political theater. They're going to raise it. I mean, that's as certain as the fact that, unless you pass from this earthly plane, you're going to go to the bathroom today. In fact, Trump's big, beautiful bill includes a $5 trillion debt ceiling hike. That tells you everything that you need to know about Washington, D.C.'s ultimate commitment to reining in borrowing. Now, of course, this isn't a surprise. It's business as usual. This is exactly what happened. I said when we were going through the election that no matter who is elected, we're going to continue to see the borrowing and spending because it happens every single year. You can go all the way back to Herbert Hoover, and every administration that has followed has left more debt than the one before it. So, I mean, it's the old, they attribute it to Einstein. They say, insanity is doing the same thing over and over again and expecting a different result. Changing administrations and expecting the next one to actually fix the borrowing and spending problem, it ain't going to happen. And it's a political reality, right? Politicians are driven by incentives. We are all driven by incentives. Incentives matter. And politicians, they're incentivized by votes. And votes happen every couple of years, every 4 years, 6 if you're a senator, but for most 4 or less. So that's their time horizon. They're not worried about fixing something 10, 15 years down the road. They're going to be long gone. So they're not going to put you through pain that might cause you to not vote for them. And fixing the borrowing and spending problem would cause a lot of pain because, we've got this bloated government that does so much. We've seen just the ripples of Doge, and Doge hasn't really done all that much yet. So, yeah. So we're up against the debt ceiling. There's a $5 trillion debt ceiling hike in this bill. It's interesting. If you go back and look at the debt ceiling, I don't even know why they bother with it, right? Congress imposed the first debt ceiling in, get this, 1917, right? It was the Second Liberty Bond Act, and it capped the national debt at, get this was the first debt ceiling, $11.5 billion with a B. Right. This was supposed to put some kind of restraint on government spending or on government borrowing, which if you can't borrow, you can't spend. Right. Of course, it didn't. Every time the debt approached the ceiling, Congress just raises it. Between 1962 and 2011, lawmakers jacked up the debt ceiling limit. I'm using air quotes around limit. Get this, 74 times. That's according to the Congressional Research Service. In 2013, Congress came up with a new trick. Instead of raising the debt ceiling, they just suspended it, right? In 2014, Congress set the debt limit with a built-in auto-adjust. And the auto-adjust ended in March 2015 with the debt ceiling set at $18.1 trillion. So in other words, they just basically said, okay, when we hit this level, it's going to automatically adjust up. Convenient, right? After that, Congress suspended the debt ceiling 4 times, and that includes the last pause, which is in 2023, and now this current one. So it's clear that the debt ceiling doesn't do anything to slow down the fast-spending drunken sailors up there on Capitol Hill, but it does afford a great prop for politicians to grandstand. So that's why if you hear them, any debt ceiling, quote, debate, it's not a debate. They're going to raise it, period. So, I mentioned the spending, and you might think that with Doge and all, spending would be falling, or at least steady. It's not. Spending is up. The Trump administration blew through $591.77 billion, so over $500 billion in April. That was 4.4% higher than the spending in April of the previous year. So far in the fiscal year, so the fiscal year starts in October, $4.16 trillion has been spent by the federal government. That's an 8.9% increase through the first 7 months of fiscal 2025. So spending's not slowing down. And the aforementioned Big Beautiful Bill would add something like $2.3 trillion more to the debt over the next 10 years. This is according to the GAO. And that's factoring in all of the rosy economic projections that always go into these estimates, right? The reality will be worse because there is no way that we will get the Goldilocks economic scenario that the CBO, Congressional Budget Office, assumes in all of their estimates. So there is one thing that is certain in D.C. Politicians will always find new ways to spend money. So the budget's just the start. They're going to spend more money. There will be a crisis, a disaster, a war, a thing that the government will feel the need to write checks for. Now, the reaction to the debt downgrade by Moody's was interesting because it foreshadows the problem with all of this debt. And this is where it really becomes relevant to investors, people who have money in the market, whether it's stocks, bonds, precious metals. This debt situation is going to have a profound impact on the markets down the road. And the Moody's downgrade, the reaction kind of foreshadowed that. Treasuries sold off. So there was a big dip in the Treasury market. The 10-year Treasury yield surged to nearly 4.6%, and the 30-year hit levels not seen in nearly 18 years, up near 5%. So what is that telling you? It's telling you that demand for U.S. Treasuries dropped. Prices will fall, and when prices fall, yields go up. So the price of a bond and the interest rate on that bond are inversely correlated, okay? So not surprising that we saw this sell-off in bonds. Moody's basically reminded the world that the U.S. is mired in a fiscal mess with no political will to fix it, as we've already discussed. And so people are looking at that, and why would you lend even more money, right, to your irresponsible drunk uncle? You wouldn't. And I think a lot of people out there in the investment world are starting to think that. They're like, maybe U.S. Treasuries isn't the best investment right now. Moody's kind of reminded us of this. So let me just put it in the simplest terms possible. People are getting wary of holding U.S. debt. And what happens if people decide they're no longer willing to lend money to Uncle Sam? Well, bond prices are going to keep falling, and yields, interest rates are going to keep rising even more. It's basic supply and demand. If you're putting more of something out there and fewer people want it, the price is going to go down. And with a bond, the yield is going to go up. It's the market's way of trying to entice people, right? We'll pay you more interest if you'll borrow this money. The slide in demand for treasuries is exacerbating and will exacerbate a growing problem for the federal government. As yields go up, it becomes more and more expensive for the federal government to finance its borrowing and spending problem, right? When you see bond yields rising, it's good for investors if you're trying to get yield. You can invest in bonds and get more money back, assuming that, those bonds are good and that they don't default. But for the government that's trying to borrow money, rising interest rates are not a good thing, right? As yields rise, it becomes more and more expensive for the federal government to finance its borrowing and spending problem. And we're already seeing this. I mean, this is happening now. Interest on the national debt cost $101.7 billion in April. 1 month. $101.7 billion in interest expense. That brought the total interest expense for the fiscal year to $684.1 billion. That's up 9.5% over the same period last year. And last year, for the first time, we saw a interest expense over $1 trillion for a year. So, to put this into some perspective, in fiscal 2025, the federal government has spent more money on interest to pay on the debt than it has for national defense, than it has for Medicare. The only spending category that is higher than interest on the debt is Social Security. Uncle Sam paid $1.13 trillion in interest expense in fiscal 2023. In 2024, it was the first time interest expense had ever eclipsed $1 trillion. And the projections are that we will break that record in fiscal 2025. And how's this for America first? The United States is number one. It has the highest debt interest payment to GDP ratio of any developed country. Currently projected to be 4.6% this year. That's ahead of Greece, which is at a mere 2.5%. And this is only going to get worse. There is a lot of debt to be refinanced that's coming down the pike, and it will be refinanced at higher interest rates. So interest expense is going to keep going up and going up. It's a spiral upward. So get this, there are nearly $700 billion in treasuries on the books right now with maturities of 1 year or less, and another $1.45 trillion in treasury securities that will mature in the next 5 years. So, if the U.S. was just going to pay off this debt and then not borrow anymore, that would be fine. It has to borrow to cover the deficits, and then it has to borrow to kind of roll over all of the debt once it matures, right? It's having to borrow money to pay back the people that it borrowed money from before. It's a Ponzi scheme. So where's the off-ramp here? Well, there isn't one. This highway's going off a cliff, and we passed the exit a little while ago. Now, some people think that the Federal Reserve can intervene with rate cuts and kind of mitigate Uncle Sam's interest problem. It's one of the reasons that you're hearing calls out there from a lot of people for the Fed, for Powell to go ahead and cut rates already. I'm pretty sure that's one of the reasons that Trump is pushing for that. He knows that the government has a problem in terms of its borrowing costs. And the hope is that if the Fed will step in, lower rates, well, maybe that'll, bring down those yields. But the fact of the matter is the Federal Reserve has very little control over the long end of the yield curve. It can manipulate that short end, right, with its rate cuts, but it can't do anything about the 10-year or the 30-year. And that was apparent when we saw Treasury yields spike even after the Fed cut interest rates. Right? When they went in this interest rate cutting spree, they cut, 3 times, basically trimmed a percentage off. Treasury yields went up. So this goes to show that what the Fed is doing on the short end of the curve isn't really impacting the Treasury market because other dynamics are overwhelming what the Fed is trying to do. Supply and demand dynamics are overwhelming. When people don't want to buy bonds, the price is going to drop and yields are going to go up. And it doesn't matter what the Fed does. There's only one option, and that is to monetize the debt. And what does that mean? Well, in a word, inflation, right? Debt monetization is when the central bank steps in and it effectively turns that debt into money that gets injected into the economy. What I'm talking about from a practical standpoint, and if you're a regular listener to the show, you're going to know exactly what this is. I'm talking about quantitative easing. That's the fancy term for it. It's bond buying. Right? The Federal Reserve can ease pressure on the bond market by buying treasuries. They just go out in the open market, they buy treasuries, and then they hold them on its balance sheet. They basically take them out of circulation. So this demand that the Federal Reserve is creating pushes the price up and it pushes yields down. It literally sticks its big fat thumb on the bond market. So again, in effect, what QE does is it turns Uncle Sam's debt, these treasury notes and bonds, into cash. And this enables the U.S. government to borrow more money at lower rates than it otherwise could under normal market conditions. It is a government intervention. I mean, we can debate whether or not the Federal Reserve is government or private. It's government in terms of its function, right? And, this is exactly how the U.S. government was able to borrow so much money during the pandemic, right? Between the time it launched quantitative easing for the pandemic, this was March of 2020, between then and May of 2021, so just a little over a year, the Federal Reserve purchased $2.44 trillion in U.S. government bonds. In effect, the central bank monetized more than half of the debt the U.S. accrued during all of the pandemic stimulus and spending. No other entity bought more U.S. bonds during the pandemic than the Federal Reserve. Not foreign investors, not U.S. banks, not U.S. corporations, not individuals. The U.S. Federal Reserve was the biggest buyer in the bond market during that time, and that is exactly why the U.S. government was able to continue buying or continue borrowing to the extent that it did. Again, the Fed put its big fat thumb on the bond market. Now, what's the problem? Well, the Federal Reserve runs quantitative easing with money that's created out of thin air. Again, think about the term. We're monetizing the debt. We're turning the debt into money. It is new money. With a few keystrokes, the central bankers over at the Fed transfer money that never existed until that very moment to a bank or financial institution in return for these treasury securities. It's exactly the same. If we could go to the grocery store and write a check, I don't know if anybody writes a check, but let's say you use your debit card at the grocery store and there's no money in your account and yet the bank pays it and you don't ever have to put any money in the account, right? That's what the Federal Reserve has. It has an account that you never have to put money into. There's always money there. I want that account. But obviously that's a problem, right? Because the central bank holds these assets on its balance sheet, but it's injected this newly created cash, this money, into the banking system. So the effect is to increase the money supply. And the secondary effect is it incentivizes borrowing and ostensibly drives interest rates lower. So banks can take this newly minted cash that the Fed just gave them, and it can go and make loans, right? So this increases overall liquidity in the financial system, and theoretically, it stimulates lending and it boosts the broader economy. This is why the Fed ran quantitative easing during the Great Recession. The whole hope is that this would, inject this money into the economy. The point then wasn't to monetize the debt. Now It needs to monetize the debt. Now, keep in mind that properly defined, inflation is an increase in the supply of money. We've talked about this in recent shows. So when the Fed creates money out of thin air, or as we say it kind of tongue-in-cheek, money printing, it is driving inflation. It is inflation. Now, inflation can manifest in a lot of different ways, right? During the Great Recession, banks tended to hold on to this newly created money. They kept it in the financial system. They invested in stocks and bonds. So a lot of that went into asset markets. And we saw asset inflation. We saw a stock market bubble that blew up. Inflation during the pandemic was a different matter. The federal government showered the population with stimulus checks. So a lot of that inflation, that increase in the money supply, actually showed up in consumer prices. So just because you're not seeing prices for the consumer go up doesn't mean there's not inflation. You can see inflation in the stock market. I think we're seeing that today. Because contrary to what you might think, as I've talked about on the show, I've written articles about it, I'll link to one on the show notes page. The inflation situation right now is it's going up. Interest rates may be steady. The Fed may still be shrinking its balance sheet, but the money supply is increasing, and that is inflation. Now, ironically, as I've already kind of alluded to, quantitative easing also incentivizes debt, right? Because when banks have this new money, they can lend, and they can lend at lower rates. There's a bigger supply of lendable money, so that means more loans, and people are incentivized to borrow. Companies, corporations, individuals, and that is exactly how we got in this situation to begin with. Basically, since 2008, the government and the Federal Reserve has held interest rates artificially low and operated quantitative easing. They've tried to stimulate, and they've created this debt bubble. And we see it clearly, not only in the U.S. government, but also in consumer debt and in corporate debt. So here we are. Thank you, Fed. So to kind of sum it up, the overall long-term impact of quantitative easing is overwhelmingly negative. It distorts interest rates. It incentivizes massive levels of debt bubbles. It creates misallocations of economic resources. It blows up bubbles throughout the economy. Eventually, the bubbles burst. The debt becomes unsustainable, and this leads to a bust. So that's why I'm really focused on the national debt more than the tariffs. I'm not saying that the tariffs don't matter. I've said that I think the tariffs could be a pin that pops some of these bubbles, but it's one tree. You've got to look at the entire forest, and the forest is riddled through and through with debt. And when we talk about the national debt, again, it's important to understand that this problem, the debt problem, is playing out also in corporate debt, and it's also playing out with consumers. Plays out in different ways, but it's all negative. And this is a huge lead balloon that is attached to the economy. And mark my words, the Fed will ultimately step in and monetize the debt. That's the only pathway. That's the only thing that it can do at this point. I don't see any other viable solution. It's either that or default. It's either got to monetize the debt so they can continue to borrow and spend, or there's going to be a default. One or the other. And the Fed has shown over and over again throughout history that when push comes to shove, it will pick inflation over a market meltdown, over an economic collapse. And I honestly think that Jerome Powell is a little more hawkish on inflation than some of the prior Federal Reserve chairs. I think he's more so than Bernanke, but I still think that he's cut from the same cloth. And again, when push comes to shove, he's going to pick inflation. I could be wrong about that, but if he continues to hold interest rates high in this debt environment, that's going to create a whole nother bit of chaos. I've talked about this over and over again. The Federal Reserve is in a catch-22. It simultaneously needs to raise and lower interest rates, and that's not a thing. So what does any of this mean for precious metals investors, right? I want to say first off that none of this debt monetization and Federal Reserve, none of this stuff would be possible if we had a sound money system. If we had a money that was backed by something, gold or silver, clams, I don't know, something, right? But when you have a fiat currency that you can just print without restraint, well, that's what the Fed's going to do. That's what quantitative easing is. Fiat money makes that possible. It would not be possible in a sound money environment. And that's why it's imperative to continue to push for sound money alternatives. Because if we don't get sound money, even if this whole thing collapsed and fell apart, if we rebuilt it on the same foundation, we'd be right back here again. It's the nature of the system. It's the nature of a fiat monetary system. You need sound money. But more specifically, if you are holding gold and silver, in my opinion, and I'm not a financial advisor, but given this, I'd think twice before selling my gold and silver just because you hear there was some tariff relief, right? You might want to keep holding on to that. Now, conventional wisdom is that when interest rates rise, it creates headwinds for gold and to a lesser degree for silver, because gold is a non-interest-bearing asset. So you might think, well, Mike, if you're right and we're going to head for this bond market meltdown and we see bond yields go way up, why wouldn't people start buying bonds to take advantage of that yield instead of holding gold, a non-interest-bearing assets? But you have to think about the situation. We're talking about a massive debt crisis. We're talking about a meltdown in the bond market. People aren't going to buy bonds to protect themselves from bonds, right? So conventional wisdom goes out the window. And if the bond market melts down, that money has to go somewhere, right? And some of it, a good amount of it, I would guess, is going to go into gold and silver, right? Because it is a safe haven asset. And we're already seeing a rotation from dollars into gold by many central banks, right? A sovereign debt crisis will only exacerbate de-dollarization. And I've talked about de-dollarization a lot. It is ongoing. It is a thing. It's something to be concerned about. And the situation is being sped up. The weaponization of the dollar, using it as a foreign policy tool, has sped it up. And I believe that concern about the fiscal situation is also speeding up de-dollarization. And then there's the inflation aspect. As we saw during the pandemic, massive Federal Reserve intervention into the bond market is inflationary. So if that's the route that the Fed has to go, and I think that's the only path, then that means you're going to want to have an inflation hedge. It means you're going to want to have real money because they're going to devalue more your dollars, your fiat currency. So you want to get out of that fiat currency. You don't want to be holding that as it devalues. You want to hold real money, gold, and silver. So I think that the current scenario is very bullish for gold and silver. And I think that is part of the reason I think this is playing out slowly. You know, they say things happen slowly and then all at once. I think that's why we're seeing this big rally in gold over the last year and a half, because these concerns are bubbling to the surface. They're coming to the head. But don't get too caught up in the one tree, right? Try to look at the entire forest and remember that just because, you know, there's some news on Twitter or on X today, you know, doesn't mean you should knee-jerk sell your gold. I think that these dips in the price are buying opportunities. And so, you know, if you want to have real money, if you want the inflation hedge, if you want to be set up for a massive debt meltdown, a bond market meltdown, then today's the perfect day to call 800-800-1865. Talk to a Money Metals precious metals specialist. Get yourself some gold and silver. They can help you figure out how gold and silver will fit into your broader portfolio, into your investment strategies. You know, if you don't have a lot of money, you know, like I don't have, you know, $5,000 to put into gold right now. That's fine. We have a program where you can actually, for as little as $100 a month, you can build a precious metals portfolio over time. So there's options out there. Give them a call. If you don't like talking on the phone, you can always just go to moneymetals.com, chat with a precious metals specialist online. Or if you're just wanting to buy, you see those dips and you think, okay, this is a good time. Let's get some silver. Let's get some gold. You can do that right over at moneymetals.com. moneymetals.com. So that is a wrap for this episode of the Midweek Memo. You can get more information on all of the things that I talked about on the show and a lot more over at moneymetals.com/news. And if you want to get the latest news and information right in your inbox, sign up, get on our email list. You can subscribe to the Midweek Memo on your favorite podcasting platform if you haven't done that. And when you do, you'll also be able to tune into our Market Wrap podcast. It's every Friday. You're going to get a quick overview of the week in precious metals, along with conversations between yours truly and a lot of interesting people in the world of gold, silver, economics, and investing. Thank you so much for listening to the show. If you're enjoying what you're hearing, if you like the show, please go to your podcasting platform, leave a nice review, crush the like buttons. That helps spread the show. It's the best thing that you can do to kind of support this show, and we really appreciate it. So again, thanks for listening. I hope you have a fantastic rest of your week.